On to Calidus, Trav. Calidus on track to meet guidance with record 16,000 ounces of gold sold. Been heavily talked about, and Calidus reflects our new logo. We're going to tie this in. The Lassonde curve.
Mate, no spoilers. Come on.
Oh, should have I spoiled it? I've got that. That's the hook.
That's the hook.
That's the YouTube hook.
That's the hook.
Take it away, brother.
Matty, it's a pretty similar style of announcement in my perspective to the Red 5 one that we saw literally last week, and we gave a big talk about what sort of transpired in the lead up to their production. Calidus has undergone not the same, but not a completely different journey themselves in terms of getting finance. Their financing process actually happened a lot faster. However, they've similarly experienced a few hiccups in the ramp up process, and I'll break this down by actually discussing that Lassonde curve. This is for the YouTube listener. I'm going to bring it up on screen, and what we see here, thanks to Visual Capitalist, is a very visual chart that explains the value of a mineral deposit over its life cycle. And when you learn Mining Finance 101, this is the very first thing you learn, is how is a mineral deposit learned over the life cycle, from all the way from its concept to its sort of depletion and rehabilitation over time. And what we see on this chart is at the very beginning, these geologists will have some concept, they'll prove it up, they might even sort of put some drill holes in and test it, and there's some structural indication that there could be mineralization there, and then it can become a company, and the company can raise some money and get publicly listed, and they can drill a bunch of holes, and every now and again, one of those exploration companies actually finds something that's worth mining. And when that happens, that discovery happens, there's a lot of speculative interest in the stock, and you typically see the value of the company shoot right up. The speculation is enormous, and there's so much potential because you don't know how big it is yet. So quite often the stock price sort of runs away, and then what happens is, as more drill results come out, the investor community becomes more informed about the real parameters of the size and economics of what this deposit might be. And as that becomes more closed off and defined over time, then that euphoria sort of leaves the market, and the company is progressing towards mining. So they're doing the scoping study and the feasibility study, as Jonas talked about on Friday's episode. And as soon as the company starts talking about their studies, as soon as they mention the word CapEx, you typically find the investors get scared because they think, oh no, the company's got to raise money and I get diluted in an enormous amount. And that period there is called the trough of disillusionment. And you see on our picture from the Visual Capitalist that trough typically coincides with the studies and also the construction period, because it can take a long time and there's no new exciting news. There's no new big deposit. It's hard to really get excited about a company building a mine. And there's actually, in that process, there's a transition of the company becomes increasingly institutionalized from a shareholder perspective. The institutions come on board and the retail market typically leave because it's not as juicy and as exciting. So all in this process, in theory, if a company executes well, it's becoming de-risked over time, even though when they're building it. And so they're de-risking the whole process, and they're getting closer to positive cash flow. And so what you typically see is that re-rating that happens, and you can see that by the bump up in the life cycle curve. When that re-rating is supposed to happen, in theory, it sort of maxes out right as the company starts producing, and all of a sudden you can see that this is going to be a really great mine, and then the value of the mineral deposit declines over time as depletion happens. But if you're a shareholder, you're getting those returns in the form of dividends, or the company's reinvesting that capital efficiently. So that's kind of the gist of mining finance, all the way from concept through to depletion and rehabilitation. Now, why is this relevant to Calidus, you might ask? Well, I'm just going to bring up a bit of a share price of Calidus, and I've just marked on top of it just some key dates for the listeners and watchers out there. So kudos to Google for this share price chart. There is a bit of chart crime going on because the y-axis only goes down to 0.2, so things aren't as dire as they might seem visually. However, I've kept the Lassonde curve in the top right corner there, and you can kind of see that we almost get it. It's very, very, very similar to the Calidus share price. Calidus, they put out their DFS in September 2020, and they called themselves fully funded in December that year, but they funded it with 80% debt, and that's a pretty big number. And then they went through that trough of disillusionment, as you can see, and they started mining in December 2021. The first ore they began processing in April 2022, and all this time the share price is going up, largely because of that de-risking. So the market is under the impression that they're de-risking, things are getting better, share price is going up, and instead of keep going up all the way until they start mining, then it starts to trend down, and that's because we get a bit of a sniff that things aren't quite going smoothly. In August 2022, Calidus raised $20 million of new equity, and the use of funds that they purported to market was to fund their growth projects. But by the September quarterly, the market got a sniff that ramp up of the Warrawoona project was not going as smoothly as had hoped, and the company actually mentioned that there was grade control reconciliation issues. The mill head grade was 0.78 grams per tonne versus the diluted grade control model prediction of 1.01 grams per tonne. And in a low grade operation, that causes enough alarm in the market to get worried. So, and I think that partially explains why you see that drop off in share price that's happened since. The company though did announce commercial production in January of this year, which in theory means that they're making money on the asset. And this announcement today is that they're on track to meet their guidance, and that's a positive announcement. But however, I'm still not overly optimistic about the outlook of the company, and by the looks of it, neither is the market, based on the way the share price is trading. And that's because there's a few things you need to keep in mind, that even if they're making money on the asset, this company is going to be stretched just to service their debt. So they've got $102 million of outstanding debt at the moment, and on the last quarter alone, they had to spend $7.4 million to service that debt. $2.4 million of that was interest alone, and then on top of that large debt quantum, they've got 127,000 ounces hedged at the moment at a forward price of $2,400 per ounce Aussie.
Oh, that sucks.
When the current gold price is Aussie 3,000 per ounce, you're constrained to ever really make decent margin on the gold that you're selling. So when you look at Calidus's cash position, they finished the December quarter with $12.4 million in cash and bullion, and that doesn't leave them with much breathing room when you have $102 million of debt to repay. Your hedge book is so far out of the money that you can't make decent margin, and you've already had some issues on ramp up. And I think that's why we're seeing the share price doing what it's doing right now, rather than going up all the way until you're producing like the Lassonde curve happens, and then declining with depletion. So just to circle all the way back on this beautiful Lassonde curve, the astute money miner out there might have noticed that we've had a bit of a marketing refresh over the weekend, and you might be able to pick out what we've chosen for our new logo, Matty. It is in fact the Lassonde curve.
Have a look at that. It's at that inflection point. You say that's I guess the end of our logo is that point. Is like, is it going or is it not? As you see, Calidus kept going beyond that point.
Yeah, I think that was really well put, Trav. And there's a few things I just want to add to that. Firstly, with regards to hedging, that's often not something that the company has an awful lot of say in. Like you mentioned in Calidus's case, they had a debt to equity ratio of 80-20, which you'd often imply from that the people that have provided the debt would want to put a few assurities around that, and they would make the company hedge some of its forward or future gold production. And just to really emphasize this point and put it into perspective across the market, there's a few other companies that we follow that we've spoken about over the last week that are going through this exact experience. So Galena is one that comes to mind. They've just gone into a trading halt. They're coming out as they've just finished constructing the processing plant. Mincor were in that ramp-up phase. Panoramic is another name we'll speak about soon, who are also in that ramp-up phase. And it really highlights that there's different stages on the Lassonde curve, which are attractive and come with different risks to different investors. So that initial phase is really exciting. A lot of retail speculators will be in there. That secondary sort of uptick that we see is where a lot of institutions will come in and try and determine that this is a risk they're comfortable with, or it's a management team that they believe can mitigate all the risks and get the company from being a developer to being a producer.
With the hedging, say you've hedged 120,000 ounces like these guys have, can you sell half hedge, half spot, or do you have to sell all your hedge first? How does that all work?
They're typically structured. I mean, correct. They're not fully hedged, Calidus, by any stretch of the imagination. They are still exposed to spot because they've spread that hedging obligation out over several years.
Yeah, companies will have various strategies. WAF comes to mind as a company that doesn't like to hedge, but other companies will have strategies such as hedging 1/3 of production for each of the next 3 years, as an example.
And that's a fun. Like, there's obviously the risk side, but do you say it's heavily dependent on debt as well? Debt can be you will be required to hedge
debt,
to fulfill.
and once
debt
the debt's
obligation.
paid down, just a decision by management.
Yeah. Very good, lads. Good work, Trav. Great release of the logo and tied in too. Some great mining news.